How do you do Treasury buybacks? Well, you need your TGA account. For those who don't know, Treasury general account needs to be replenished to then use that capital to purchase treasuries. Okay, well, they can't do that. And so how do they do that? That's QE essentially, right? Well, you need to revalue gold. If you revalue gold, you increase your TGA account because that's essentially collateral value that would allow the TGA account to be massively increased. It could be increased by $700 billion at current gold prices. But if gold prices run another 10, 20, 30% from here, it could be even higher. So it is in the best interest of the administration to also allow gold to run.
Gold prices continue their remarkable ascent, recently testing a new all-time high of $3,500 an ounce. Despite disappointing economic downgrades, the gold market remains resilient, buoyed by strong bullish momentum and increasing demand from major institutional players. While traditionally seen as a safe haven asset, gold's performance in the face of a looming recession has drawn mixed opinions. Some analysts warn that in the early stages of a downturn, investors may be forced to liquidate profitable positions in gold to cover losses elsewhere, particularly in equities. However, historical trends suggest that gold often outperforms equity markets during broader economic slowdowns, reinforcing its long-term value as a defensive asset. Tavi Costa, macro strategist at Crescat Capital, points to the mystery surrounding the recent surge in demand. Gold prices are surging, but the big buyers remain unknown. Export data from London and Switzerland shows significant outflows which have impacted their GDPs. Some suspect central banks or sovereign buyers like China or Russia, but no one knows, Costa said. Billionaire hedge fund manager John Paulson believes central banks will continue accumulating gold to hedge against political instability and currency devaluation. According to Paulson, in an environment where paper currencies are increasingly vulnerable, gold offers a more secure store of value. Bullion has surged approximately 30% this year, outperforming nearly all major asset classes. Amid ongoing global tensions and weakening confidence in U.S. Treasuries, traditionally a go-to safe haven, investors are increasingly turning to gold as what Paulson describes as the only true safe haven left. Costa also highlights a strategic advantage for the U.S. government in this gold rally. Revaluating the metal could significantly enhance national liquidity if the U.S. holds more gold reserves than its peers. Revaluing gold could boost the financial capacity of both the Federal Reserve and the U.S. Treasury, Costa explains. It's essentially an increase in collateral, allowing greater flexibility to inject capital into the system when needed. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
There's two things that could solve, especially if they are the ones driving gold prices higher by accumulating gold. Who knows? I mean, we don't know. I'm open-minded to it. I don't know. We saw this data coming from London and also Switzerland in terms of exports of gold, which has been hurting. The imports have been hurting GDP. Nobody knows who is buying this to the degree that we're seeing, but someone is, and it's a big party. Is it the Fed? Is it the government? Is it China? Is it Russia? I don't know. Nobody knows that answer, and we can all speculate. But certainly is in the best interest of the administration to see gold prices rising, especially if they think that they have more reserves than other countries. I don't know. I'm not sure about that. Again, I don't think anybody knows that answer. Now, what we do know is that if they do revalue gold, it would increase the liquidity on the Fed front, on the Treasury front, and that is the big benefit. It's increasing basically your collateral. So now you have an increase of liquidity in the Treasury general account, potentially could drive it up to, now they have 300 billion. It could get up to maybe $1.5 trillion. $1.5 trillion, to put into perspective, is a lot of money to be buying treasuries and then instructing the banks to do the same and then instructing Japan, Europe to do the same. I mean, remember, yes, China has been somewhat divesting from, or at least not rolling their treasuries, and they have been letting those run out. But Europe has still been buying treasuries, believe it or not. That's not a view, that's data. And so can they come up with a deal where it forces those economies to buy it? It wouldn't surprise me. So I'm very open-minded to those views. And I think the revaluation of gold is kind of in the middle of all this. It's the third, I call it the third pillar, but it could be the first pillar, where in the sense of being the most meaningful side of the demand for treasuries. And so, look, the government has a clear agenda, which is to reduce the cost of the debt. You can run leverage, like you can have debt to GDP reach 300% of GDP, just like Japan did. That costs your currency, and look at the interest rates in Japan versus any place in the world. So if we want to go there, which I think ultimately we will, there's a lot of macro assets that need to be adjusted. That's the dollar, that's interest rates. And I think we're in the process of seeing that from my research, at least. And what do I know? But I've been looking at a lot of things to try to understand what exactly caused the lagging. And no surprise, mining companies, at least their stock performance follows earnings extremely closely. And earnings for most of these companies were still 50+% lower than it was at the peak of 2011. So that explains why gold prices have gone way higher than the 2011 levels, and the miners have basically not gone anywhere compared to those. Now the miners have been moving higher, and that's because their margins and their earnings are improving. Long ways to go, in my view. I mean, these things are just starting to crank free cash flow. And look, I think it's important to put into perspective how much of a move we saw on the mining industry. I mean, how much cash flow can be generated over even a move like today, $80 an ounce, that has been moving almost $100 an ounce. No, that would be unheard of years ago, or at least would take months. And we're seeing in one day something along those lines. I mean, most of these mining companies, it's not like they're facing major inflationary pressures from labor and all these things. I mean, they're all sustaining costs is probably in some mines sub 1,500, and gold prices are approaching 33, maybe it will be at 3,500 in not too distant in the future. And so you have to start putting your hat of, even if gold prices fall to 2,500, these companies are still, producing at over $1,000 an ounce margins. I mean, that's insane. That's absolutely insane. I don't think anybody that is, those in the industry know this, but the people that are outside, guys, that's absolutely nuts. I don't think we've ever seen anything like this. This is what we call the golden age of mining. I mean, this is as good as it gets when it comes to profits.
With explosive momentum and a range of powerful forces, ongoing trade tensions, persistent inflation, and aggressive central bank gold accumulation, many analysts believe gold is in the early stages of a structural bull market that could extend for years. As global economic uncertainties intensify and more nations move to reduce their reliance on the US dollar, some forecasts even suggest that gold could climb to $4,500 an ounce or higher. Tavi Costa argues that a potential revaluation of gold could play a pivotal role in the U.S. government's broader fiscal strategy. While it may not be the central policy lever, Costa believes it's crucial in the push to manage rising national debt more effectively. He notes that at current gold prices of around $3,500 per ounce, such a revaluation could unlock approximately $773 billion in immediate liquidity for the federal government. Importantly, this would not come in the form of new borrowing, would not add to the national debt. This strategy becomes even more compelling as gold prices rise. For every $1,000 increase in the price of gold, the U.S. could theoretically generate an additional $250 billion in liquidity, meaning a price level of $4,000 per ounce could yield roughly $1 trillion in new financial capacity. Let's get back to the interview.
I think it all ties back to the revaluation of gold itself, the plan that Brian was referring to regarding trying to suppress interest rates, which ultimately is potentially the only way or least painful path of deleveraging here that we have, that I think it's clearly trying to be accomplished by the administration. The only way you can do this is by finding demand for the U.S. Treasury market. And there has been a few initiations of ideas in that front. We've had, potentially an accord or something along those lines, what they call the Mar-a-Lago Accord. Is a way of restructuring the debt potentially. Let's just say they're successful. You can get maybe international buyers back in the space. You can have one thing that I think it's completely under the radar. It's what's happening with the U.S. banks and the push towards administration of allowing the banks to buy treasuries. That's going to be a big thing. This is the playbook of the 1940s. It's not, I think the word that has been used in the past has been instructing the banks to buy it. I don't think it was instructing, it's really influencing the banks, almost forcing the banks to actually find a way into purchasing treasuries. And the revaluation of gold that I was referring to is the third pillar of demand that could come from the treasury market. I mean, Bassett was talking about with the Bloomberg reporter yesterday on in Argentina. I don't know when this is going to be aired out, but and where he talked about, if the Fed doesn't come to the table in terms of lowering rates and suppressing rates in general, we have other toolkits. And guess what he's referring to? Treasury buybacks, of which he talked about. How do you do Treasury buybacks? Well, you need your TGA account. For those who don't know, Treasury general account needs to be replenished to then use that capital to purchase treasuries. Okay, well, they can't do that. And so, how do they do that? That's QE essentially, right? Well, you need to revalue gold. If you revalue gold, you increase your TGA account because that's essentially collateral value that would allow the TGA account to be massively increased. It could be increased by $700 billion at current gold prices. But if gold prices run another 10, 20, 30% from here, it could be even higher. So it is in the best interest of the administration to also allow gold to run. So now you have this sort of demand coming from that side of it. And ultimately is going to drive, in my view, the revaluation of it in the Fed's balance sheet and the Treasury balance sheet, and ultimately would also drive the demand for treasuries from the Treasury market itself. And so by no means I'm saying this is a great thing, the right thing, or the wrong thing. I'm just focusing on the macro side. And I do think that lowering rates is not a target, it's a measure. It's a measure. There's a difference. And so I think they're going to do this regardless. We'll try to, accomplish this goal somehow. And in my 2 cents, the dollar is right in the middle of all this. The dollar is being pressured by what Brian talked about. International investors have been selling the dollar. But I also think that the dollar on its own is reaching a turning point of its own cycle, which has nothing to do with China, has nothing to do with Russia or Europe or any international partner. It's just the fact that we've seen too much of a run in the dollar. And it's important to notice that the dollar tends to have these super long trend or long-term trends. And we're probably just starting to see the other side of this. And so if that's the case, investors need to put their hat on and think about, all right, what is a world where the dollar devalues? What is a world where rates go lower? What are the things that should invest? Well, hard assets is one answer. There's a lot of other things that I think people are not paying attention to that could come to the table as well.
As gold continues to surge past previous records, its role in the global financial system is gaining renewed relevance. This powerful rally, fueled by geopolitical tension, inflationary pressure, and growing skepticism toward fiat currencies, has positioned gold as a protective asset and a potential lever for fiscal innovation. Leveraging gold's rising value to enhance national liquidity without incurring more debt opens a new dimension in financial strategy that could reshape how governments respond to monetary constraints. As economic uncertainty deepens, the metal's strategic and symbolic power appears more significant than ever. Could the rising valuation of gold pave the way for unconventional policy tools that redefine how governments manage debt and navigate economic crises? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.